One of my colleagues once very interestingly told me his experience with the bureaucracy, and he was talking to a joint secretary in the department. And he was talking about qualification of audit reports. And the joint secretary told him that every audit report should be qualified. So my colleague was a bit surprised and says, every audit report should be qualified. What does he mean? Eventually, my colleague understood what the guy was saying. He actually, the bureaucrat actually thought that qualification is an ISO mark, and therefore every audit report should have an ISO mark. So therefore, it's so important for us to engage these people, to engage the regulators, to engage the bureaucrats, because otherwise we'll have a bill that will have so many holes in it, and it becomes so difficult for us then to implement some of these aspects, and Naushad discussed some of them. I'm going to focus on the accounts and the audit part of the bill. Not all is lost. There are still rules that are being made, and some of these onerous provisions in the bill can be salvaged through appropriate drafting of the rules. The first issue is on consolidated financial statements. We see huge differences in the definitions that are there in the bill and that are there in current accounting standards. For example, in the current accounting standards, control would mean board control or ownership of more than 50% voting rights. In the bill, they've actually taken the definition of the SEBI takeover code, and it talks about, voting agreements and shareholders agreement and so on and so forth. So they focus more on substance. Again, as far as accounting is concerned, subsidiary is defined as ownership of more than 50% voting rights, but under the bill, it is 50% of the total share capital. In other words, what it could lead to is, in some situations, the preference shareholder, if he has 60% of his investment in that company, would actually consolidate the company rather than the person who has 100% ownership, equity ownership rights there. So this is again a big issue here. Associates, significant influence. In the accounting standard, 20% limit in the accounting standard is used as a yardstick. So therefore, even less could result in significant influence, and more may not necessarily result in significant influence. But under the bill, 20% is used as a rule. And therefore, if you have a 20% investment, that company is an associate company. So therefore, what you would have is a situation where you are consolidating a number of companies under the accounting standards, and the companies that you would consolidate under the bill would be completely different. Now, the way to resolve these issues is for the rule-making people, the rule-making committee, to say that as far as accounting is concerned, the definitions in the accounting standards would be more relevant rather than the definitions in the bill. So some of it can be salvaged in the rule-making, so that people don't have this big issue of differences in the definition. Otherwise, you will see financial statements looking completely different from what they are today. As we all know that if you see this example here, again on the 50% share capital, shares owned by A Limited is 55% in B Limited, and there is preference capital in the company. And on an average, A Limited holds 40.625%, but as far as equity rights are concerned, it owns 55%. So under accounting standards, it would consolidate the company, but under the bill, because it holds 40.625%, it may not consolidate the company. So therefore, there is a big issue in the definition, and hopefully some of these issues will be resolved in the rules. If the rules will suggest that the accounting standards are relevant for accounting purposes, as far as the definition of control and significant influence in the bill is concerned, that's more from an administrative and regulatory purposes for Companies Act purposes. SEBI had very recently, or a couple of years back, had allowed companies to prepare consolidated accounts on IFRS. And a lot of companies that were globally listed were issuing IFRS financial statements. There were some companies that were not globally listed, yet they were using IFRS financial statements. A case in point is Bharti, for example. Now, what happens is the company's bill says that you have to prepare your consolidated financial statements on the basis of notified standards, and those notified standards could be either Indian GAAP or Ind AS. And therefore, these companies that are preparing IFRS financial statements, which are globally acceptable, those financial statements may not be acceptable in the Indian context. When I had recently met Mr. Sinha in one of the SEBI conferences, and we've also met some of the people in the rulemaking committee, we said that the option to prepare IFRS financial statements for these companies should be continued. There is no exemption from preparing consolidated financial statements as far as intermediate holding company is concerned. So if you look at a company A, it has a parent company B, and it has another parent company C. So you have a chain of companies A, B, and C. In IFRS, B does not have to prepare consolidated financial statements. If all the shareholders of B agree that we don't need a consolidated financial statement, and if the ultimate parent company, which is C in this case, prepares consolidated financial statements. Now that exemption, again, is not available in the company's bill. Hopefully, again, we have made very significant representations to the government and said that that exemption at least should be there, and if it's not in the bill, it should at least be in the somewhere in the rule. But again, there will be huge questions. Can a subordinate legislation override the main legislation? So these are the things that will really have to be dealt with. And there is confusion with respect to associates and joint ventures. So for example, section 129 of the bill says that for the purposes of consolidation, subsidiaries will include associates and joint ventures. Now this could have several meanings. One of the meaning is that even if you don't have subsidiaries, you have to prepare consolidated financial statements if there is an associate or a joint venture. The other meaning could be the innocuous meaning or the current practice that is followed, that only when there is a subsidiary you consolidate financial statements, you prepare consolidated financial statements, and you do the equity and the proportionate consolidation for associates and joint ventures. The worst argument could be that if you have to treat associates and joint ventures as subsidiaries, then you have to fully consolidate these companies, which obviously may not be anybody's intention. But it's bad drafting, and somebody could misuse some of these provisions. I don't want to go too much in detail on depreciation because Naushir has already said that that's a thing that's not really relevant. But as you see, the lives of several assets have been reduced very, very substantially, and analysts do look at net profit numbers, and therefore depreciation to some extent, or to a large extent, is also relevant. But one of the most interesting thing in depreciation is the transitional provision. The transitional provision says you have to depreciate the remaining unamortized depreciable amount over the remaining useful life. So let's say you have depreciated your asset by 50%. Or 60%, and then there is a remaining unamortized depreciation amount of another 50. If all of the useful life has been expired in accordance with Schedule 2, then that 50 gets hit to the retained earnings. But if 1 or 2 years is remaining as useful life, then that 50 gets charged in your P&L account for the next 1 or 2 years. So the transitional provisions that are there in Schedule 2 could provide really harsh outcomes in a lot of situations. The depreciation on revaluation also has changed significantly. In the past, the incremental depreciation on revalued could be recouped out of revaluation reserve. In the current Schedule 2, you can't do it because depreciation in current Schedule 2 is based on cost or substituted cost, whereas Schedule 14 required depreciation on historical cost. So again, those things could have a huge impact on your P&L account. We all know people use Section 78 to write off their preliminary expenses, and largely all these, redemption premium on preference shares and FCCBs and debentures and so on and so forth. Now, Section 52 in the bill does not permit you to do that. If you are a company that's a prescribed company or that is following notified standards and so on and so forth. So essentially, the provision has been introduced to align the requirements of IFRS or Ind AS with the requirements of companies' bill.